is probably the easiest math in the whole class, which also makes it very likely that you will screw it up, unfortunately. Because what you inevitably do with this question is to overcomplicate it. On the exam, they're going to want you to calculate interest paid over the life of a loan. And inevitably, you start scrambling looking for interest rates and calculating how much interest per payment and multiplying that times 12 payments a year. And you just go crazy with this thing. Let me ask you I'm going to give you a simple example, and then hopefully you'll be able to see where we're going. If Alice lets Patrice borrow $1,000, okay? Alice is going to loan Patrice $1,000. And here's how they've structured the repayment. Patrice is going to pay $100 a month for 12 months. Is everybody with me on that? Can we figure the total amount that Patrice is going to pay back on that loan? Yeah, it's what? $100 a month times what? 12. Times 12 months. So she's going to pay back a total of $1,200. Is everybody with me on that so far? Yes. How much did she borrow? $1,000. So what if I ask you how much interest did Patrice pay, what could you do to figure out the interest paid over that course of that loan? Simply subtract $1,000, and so therefore she's paid $200 in interest. Now let me ask you a question. Did you need an interest rate to calculate that? All you needed to know was the what? The monthly payment and how many months that payment got made. Well, guess what? The same thing is true of those big, bad, ugly mortgage loans. The only thing you need to know is the monthly payment and then how many times that monthly payment gets made. And that'll calculate the interest paid over the life of a loan. So let's go in here. So for example, how much is the total principal and interest paid over the life of a 30-year mortgage loan issued at 5% interest with monthly PI payments of $1,074? They want to know the total principal and interest. Well, guess what? They gave us a principal and interest payment, didn't they? So, how many months of the year are we going to pay that $1,074? 12 months. That's the first thing we do. 1,074 times 12 months. And how many years are we going to pay it? 30 years. So there's a total of $386,640 paid back on that note. Does that make sense for everybody? Could you follow that up and answer the question of how much of that is interest? Yes. Yeah, because you know how much of how much of it is principal in most cases. So when you get something like this, if that's a $200,000 loan and you calculate that the total paid over the life of the loan is $386,640, how would you calculate the interest piece of it? Just subtract what? The $200,000 that was borrowed. The same way our simple example over here was. Take the total of all the payments and subtract the amount that was borrowed. Well, the total of all the payments right here is $386,640, and the amount borrowed is what? $200,000. So the difference is the interest that's paid over the life of that loan. It'd be $186,640 in interest paid over the life of that loan.
So,
do you have a question?
I might have had a light bulb moment. When I look at an amortized chart, is it breaking up like the total amount, just telling you segmented, like, you know, as the interest goes down and the principal goes up? Is it just kind of breaking down the details of the overall amount over that?
I'm not. What kind of amortization chart are you talking about?
Let's say it's a monthly, like 360.
You talking about looking at 360 payments?
Yeah.
If you look at all 360 payments,
Yeah.
yes, it does break down how much of each payment goes
But
toward
for
principal
that
and how
total
much.
amount?
Right, so if you sat there with a
Okay.
calculator
Okay.
and you added up all the interest on all 360 of those payments, it would be this
The
number.
aha moment is I just didn't know that you could actually calculate the total amount without amortizing
That's it,
individually.
you don't have to.
Didn't realize
Because
that.
you know you're paying $1,074
Okay.
every single month,
Huh,
12 months a year
interesting.
for 30 years.
Okay,
So if you multiply those out, that's the total payback. Does that make sense?
okay.
And it's the total payback minus what you borrowed. The rest is the interest.
Okay.
So on this loan, how much interest is the bank getting? $186,640. And by the way, that's a real number. At 5% interest on a $200,000 loan, that's how much interest would be paid over the life of that 30-year mortgage. Almost doubles the principal amount of the loan. Isn't that crazy? At 5% interest, you end up paying almost double back. What do you think about 12 or 13% interest?
I finished 7 on a 5.
Astronomical figures. Yeah.
I finished 7.
So that is, believe it or not, the end of the math in this chapter. That's cool. Would I repeat that statement for you?
Hey now.
Go back to this one?
Yeah.
Okay.
386,640.
Yeah. That's the total amount we paid back, because that's just our monthly payment times 12 payments a year. So that's how much we pay in a year, right? Take your monthly payment times 12, that's your yearly payment, and you're making that for how many years in this question? 30 years, right? So times 30 gives you that total of 386,640. Well, that's the total you paid back, but you borrowed 200,000 of that.
So when you say pay back, that's what I'm going. When you say pay back, pay back to the
bank.
Okay.
You're going to pay the bank a total of $386,640 if you make all those payments. If you make every single payment on time, that's the amount of money that those payments will total up to. Well, the question is, how much of that is interest? To figure out how much of it is interest, you need to subtract how much of it was real money. In other words, how much did they lend you? Because what you pay back is their money plus interest. Does that make sense? So, how much money did they lend you?
Okay,
$200,000. So the total you paid back minus the $200,000 they loaned you is how much you paid them in interest while you had that loan. Do you understand this one? Same thing. What'd you do over here? Monthly payment times what?
12.
Why times 12?
Because it's been a year.
But no, because I said you were going to make how many payments?
Oh, 12.
12 payments. And so that's a total of $1,200 paid back,
Right.
but how much of it was borrowed money? 1,000. So what did we do?
Subtract.
We subtracted the 1,000 we borrowed from the total we paid back. Isn't that the same exact thing we've done over here? We've taken the monthly payment, and in this case we multiply it times 12 times 30 because we're paying it 12 times a year for 30 years.
So is but this is not interest paid back to the bank.
Yes,
Okay.
that's exactly what this is. This is interest that is paid to the
Well, I'm
bank.
talking about the 386,000.
That's the principal and the interest combined. That's the total amount you paid back to the bank in total for principal and interest. So if you want to know just the interest piece, you've got to subtract out the principal, the amount you borrowed.
Okay.
Got it now?
Yes.
Okay, good. Good. It's a weird ring. Okay. All right, are we good on this idea here? Okay. So that is the end of the math for finance. That's the last piece of it. Now you've got a math packet there that's pretty extensive. That's what it's at, like 40 questions, 39 questions. Okay. So that's going to be homework. I mean, we're not done, by the way, not by any stretch of the imagination. No. I'm just pointing out that I want you to do that packet, okay? We are not done with finance, we're done with the math of finance. We still have chapter 15 to go. That's just chapter 14. Okay?
Is that the packet from last night?
Yes, the one I passed out last night. So I want you to do that packet. I will be posting a video with detailed breakdowns of that entire packet. I filmed about half of it yesterday, and then I got bored, and so I stopped. I was doing it in my break between classes, so I had to stop and went. Actually, I was falling asleep. You might hear me snore a couple times in there. I wouldn't be surprised, because I was dozing off while I was doing it. Because the camera's not on me, it's on the screen, you know, and I'm just sitting there talking to myself and doing the math. And so, I mean, you see what it does to you. It lulls you to sleep, it does me too. And it's not exciting stuff. So, all right, but I will send you a video link to that. So that, because I feel like and you guys can give me your opinion, I feel like the videos on the math homework work really well, because you can kind of at your pace go back and rewind one question at a time, versus us going over them in class when it's kind of like we go through it, and if you didn't really get it, you can't rewind that, right? So I feel like doing the videos, you can kind of go back and watch that same question over and over and over. Is that true? Does that work okay for you guys? Okay. And it certainly saves class time for us too, because it keeps us moving on a little bit better pace. So I'm going to do that, and I'll send that out to you the next day or so. That's it for the math of chapter 14 finally. And that is a lot of math. It's a lot to digest math-wise. All right? So let's get back to some other things other than math. Still wrapping up we haven't finished chapter 14, and then we have to go into chapter 15. Some different types of loan repayment plans. The most common one is called a fully amortized fixed rate mortgage. Remember, we talked about fully amortized last night. What do we say it means when something is fully amortized?
Zero balance.
At the end, you owe how much money? Zero, nothing. Because your payments are high enough that you are going to pay it all the way down to zero, which is different than partially amortized. What does partially amortized mean? You have a balance at the end, and we call that balance a what? A balloon payment. So now let's talk about the other part. Fixed rate, a fully amortized fixed rate. What does that mean about the interest rate? It stays the same over the full term of the loan. This is by far the most common type of residential mortgage, the fully amortized fixed rate. And what do you think the most common term is for a residential mortgage? 30 years. The most common residential mortgage is the 30-year, fully amortized, fixed rate note. And what that means is that every payment is going to be the same, because the interest rate is locked for the full term of the loan, as long as you have it. And these charts over here give you an idea of what's happening with the principal and interest. Early on, you're paying almost exclusively what? Interest, and as time goes on, that dramatically declines, and you pay more toward the principal. Right? That's a fully amortized fixed rate. The payment stays the same. The borrower builds equity from the first payment. That's all true of a fully amortized loan. We could also have something called a term loan, which we talked about last night a little bit. What do we say it means when something is a term loan? What do we pay? Just the interest on the note, just the interest. So we're not amortizing at all. We're not paying that loan balance down at all. We just are paying the interest as it accumulates on that note. And the balance at the end, or the balloon payment, is going to be the full amount that we borrowed, because we've not made any dent whatsoever in the outstanding principal balance. You're going to see adjustable rate mortgages on the test. They're going to want you to know certain characteristics of adjustable rate mortgages. What's the biggest characteristic? That the interest rate can do what? Can change, can fluctuate. Now let me ask you, be honest, which way do they normally fluctuate? Upward. Because here's the thing, folks. If a borrower has an opportunity to get a fixed rate mortgage, they would never choose to get an adjustable rate instead of a fixed rate unless the adjustable rate had a much lower what? Interest rate. That initial interest rate would have to be a lot lower to entice somebody to go after the adjustable rate note. Well, if it's very low in the beginning, we call that a teaser rate, which means it's probably going to adjust which way over time? Up, absolutely. And those rate changes are usually tied to some like publicly traded index, like the prime index rate, for example. The prime interest rate, I mean. Or I mean, there could be a number of things. But the note will say, the note, remember, is the loan, is the contract, would say what the interest rate is tied to. So you could look up at any given time and see what the interest rate is going to reset to on an adjustable rate mortgage. It's not some mystery thing. You can always look it up. Yes, ma'am.
Is it possible, I don't think it is, but has an arm ever went down?
Yes. Not in residential loans, generally.
Okay.
The truth of the matter is that in commercial financing, you find almost no fixed rate notes. Almost everything in commercial real estate is adjustable rates. And because everything's adjustable rates, because there's no choice to choose a fixed rate, they don't do the teaser rate. You pretty much get the market rate. So if market rates go down, then what's the interest rate on your note going to do? It's going to go down. But in residential adjustable rate mortgages, they almost always adjust upward because they're almost always artificially low in the beginning. They have that low teaser rate to get you in the door. So if you have a 1-year ARM, that means the interest rate can adjust every 1 year, every year. If you have a 2-year ARM, that means the rate can adjust how often? Every 2 years, and a 3-year, 4-year, etc. 5-year ARM would mean the rate can change for every 5 years. What that means is that when you first get the loan, the rate's locked for how long? 5 years. Then it adjusts, and it stays at that rate for how long? 5 more years. That's what a 5-year ARM looks like.
But doesn't it stop after like the third one or something like that?
Not unless it says it in the note. There's no rule that says they have to ever stop adjusting. Okay? Now, most adjustable rate mortgages do have certain caps built into them. They have certain things built in that limit how high the monthly payment can go or how high the interest rate can go. An interest rate cap is a really good thing on an adjustable rate mortgage because what do you think it caps? What does it limit? How high what could go? The interest rate. It limits how high the interest rate could go. So an interest rate cap on an adjustable rate mortgage is a really good thing. A payment cap, what do you think that limits? How high what can go? The payment. That sounds like a great thing, doesn't it? It's a horrible thing. Because just because the payment is capped doesn't mean the interest rate is. So what if that payment cap kicks in, you get to a $1,500 a month payment, and that's your payment cap, but the interest rate itself continues to adjust upwards such that you're accumulating more interest than you're paying. What do we call that when you're accumulating more interest than you're paying off? Negative amortization. So if you're looking at adjustable rate mortgages, don't be confused into thinking a rate cap is the same thing as a payment cap. They are very different things. A rate cap's a good thing, payment cap, not such a good thing.
Could there be both?
There could be both. There could be both. Okay? Everybody all right so far?
Are there usually both?
Are there usually both? They're very rare. The payment caps are much rarer than rate caps. The rate caps are more common. Rate caps are fairly common. Like, for example, the State Employees Credit Union adjustable rate mortgage is a 5-year ARM with a, let me get this right. It's a 5-year ARM. The maximum adjustment per cycle is 2%. So that's the max it can adjust either direction in any 5-year cycle. It's 2%. And the adjustment cap, or the rate cap, is 10% above the initial rate. So it cannot adjust more than 10% total over the life of the loan. That's an example of what you might see with an interest rate cap.
So we're looking at 15%
could conceivably be 15% if it adjusts, if it takes the maximum adjustment every time. Yes?
Why, I mean, other than the banks benefiting with a bunch of interest accruing, like, why do they do payment caps? Why
You just answered your own question.
Are they that crooked?
Yes, they're banks. Yes. Yes, absolutely. I mean, obviously, people like the idea of a payment cap because they like to think, well, my payment will never be more than this amount. But that doesn't do any good if the interest is accruing at a faster rate than that. So an interest rate cap's a good thing, a payment cap, not so good. Yes, ma'am?
With the ARM, you're not gonna know when you're gonna pay it off because it's gonna change.
No.
So you do know?
Mm-hmm. You know, it might be a 30-year note or a 20-year note or a 15-year note, same thing. Because what happens is when the interest rate changes, they simply re-amortize and the payment adjusts upward according to the new rate. But you're still paying principal every month, so you're still on track to pay the principal off over the 30 years.
Unless there's a payment cap.
Even if there's a payment cap, you would still be paying the same amount every month. The problem would be that you wouldn't be touching the interest. You wouldn't be touching the interest, so you would end up with negative amortization, which of course you'd never pay it off if you had negative amortization. Yes, absolutely, absolutely. If you hit a payment cap.
Okay.
What now?
No, I was thinking what JJ was thinking. If you're changing the interest rate, your principal, you're never really getting, as your interest climbs, your principal's not going down within that $300 cap.
If you have a cap, if you hit, but that's only true if you hit the cap, because otherwise your payment's going to adjust with the new rate so that you're still paying principal every month. It would be very rare to hit a payment cap on one of these. Very rare. Okay? As we said, the initial rate, that first rate is usually called the teaser rate. And the reason it's called the teaser is because it's artificially low. It's like, it's like a sugar high. It's designed to entice the borrower in. Now, truthfully, ARMs get a bad rap. They are not a good fit for somebody who's going to keep a loan for 30 years. But how many people keep a loan for 30 years? Like we talked about, for example, that state employees credit union 5-year ARM. What's the average time somebody owns their house?
5.5.
5.5, 6 years. So if you've got a young couple who's buying their first home, they don't have any children yet, but they're planning to have a family, there's a pretty high likelihood that they're going to sell this place and buy another before they even get to the first adjustment cycle on that note. Does that make sense for everybody? And if they're going to get to that, if they're going to do that, then that adjustable rate's the best deal they can possibly have because they got that super low interest rate for the first 5 years. Does that make sense for everybody?
I got one of those because I couldn't afford the whole house payment, so they did a primary loan, then they did a secondary loan to make up the difference because I couldn't qualify entirely on the first loan for the house, so they came up with a second one to bridge the first one.
Okay.
And they used an ARM.
They used an ARM. There you go.
I did the same thing JJ did, and then my balloon payment did,
Yeah.
and that sunk me bad. So,
The balloon payment, so you reach the end of the long term, or you mean the rate adjusted?
my adjusted.
The rate adjusted. Okay. That's what I thought you meant. The rate adjusted.
Yeah.
But sometimes they can adjust up like really high, really quick, right?
Well, you have to look at the terms of the adjustable rate mortgage. I mean, like I said, the state employees one is a very solid one because you know exactly what the worst case scenario is. For example, if you go today and get the 30-year state employees 5-year ARM, I believe the initial interest rate on that thing is 3.75% right now, which is significantly lower than what you're going to get on a 30-year fixed rate. And it's locked for 5 years, and the maximum it can adjust, if you take the first full adjustment, the maximum it can adjust is 2%.
Oh,
So it could go, you'll have it for 3.75 for 5 years, and if you take the full adjustment, the worst case scenario at the first adjustment cycle, you're going to go to 5.75. Well, if you average them out, that's about what you would have been paying on that 30-year fixed all along anyway. So that's not necessarily a bad loan. You just have to look at everybody's situation as individual.
Now, when they do those kind, and you get to that 5.7, is it locked in at 5.7?
For another 5 years.
Well, just another 5 years.
That's right, because it's a 5-year
And
arm.
then it can keep going up
Every 5 years.
Then that's when it can become terrible.
Right, and of course they can refinance. The theory would be that most people would have built equity and by that point be able to refinance into a fixed rate note
That's low.
at a better interest rate. Because they're a less risky borrower at that point.
And if you paid on time, that looks good. Your credit looks a lot better.
Yep, so we understanding this? Okay. And of course most of them adjust upward. And that's it for chapter 14. The different repayment plans, that's it. And we're going to roll right into 15. All right, are we good? Y'all rather take a quick break before we go into 15? I mean, we just kind of had one, right? Okay? Get it over with, Patrice said. Okay? Well, I mean, now we can nod and pretend we did. That'd be all right with me. No, unfortunately, we can't skip it on the test. So. All right, so chapter 15 is all about the bigger mortgage market. Everything in chapter 14 is one loan at a time. We're focused on an individual loan. Everything in chapter 15 is about loans by the thousands, loan by the bucket loads. We call that the secondary mortgage market. Well, what we talked about in chapter 14, we call the primary mortgage market. Here's what's happening in the primary mortgage market. Loans are being made. If you're talking about a borrower sitting down in front of a lender and getting a loan, that's a primary mortgage market activity. So the primary market is where the borrowers are. Everybody okay with that? Whereas, and in the primary market, money gets made from fees, like origination fees, discount points, and then from interest paid over the life of the loan. Those are all sources of income in the primary market. You all know the difference for test-taking purposes and for real-life purposes. You should know the difference between a mortgage banker and a mortgage broker. Let me see if I can put it in different terminology for you. Real estate brokers. Whose listings can you sell if you're a real estate broker? Not only your firms, but whose? Everybody else's. Can't you sell everybody's listings because you got that word what? Broker. So now apply that same knowledge to these words. A mortgage banker versus a mortgage broker. A mortgage broker can sell anybody's loans. Whereas a mortgage banker works directly for what? One bank. If you go into Bank of America and you go sit down in one of those little offices and you talk to somebody about a mortgage, which one of these are you talking to? You're talking to a mortgage banker. If you go on the internet and you fill out an application at Quicken Loans or Corporate Investors Mortgage Group or one of those, you're talking to a mortgage what? Broker. Because they are shopping that loan around to hundreds of different lending sources at the same time, trying to match you up with the best possible deal. That's the difference between a mortgage banker and a mortgage broker. The other difference is, and this is not on the test, mortgage bankers are generally paid salaries, whereas mortgage brokers are commissioned. Let me tell you something about that now. A mortgage broker is a wonderful thing. I use them almost exclusively. I know some great ones. I have great relationships with them. But you have to be very careful. These people are commissioned. The amount of their commission is based on the kind of loan they sell. So if they sell it at a higher interest rate, guess what? They get more commission. So don't ever just apply with one mortgage broker. You need to apply with several and shop them against each other. Don't be afraid to haggle. Here's what I guarantee you. You go fill out a mortgage application with a mortgage broker, and they'll send you a loan estimate, and they say, okay, well, here's your interest rate, and here's your payment, and here's your origination fees, and yada, yada, yada. You go apply with another lender. and that other lender comes back and their origination fee is $500 less and their rate is 1/8% better, send that second estimate to lender number one and watch what magically happens with those numbers. You know what will happen?
You can send them.
They'll beat them. And that's what you should do for your clients. You should make sure. Folks are very reluctant to do this. It blows my mind. You almost have to it's like pulling fingernails out to get them to, it's like they're afraid somebody's going to say no to them. Well, you know what? If it happens, it happens. But we need to shop this thing around to make sure you're getting the best possible deal. Yes, ma'am.
I think please correct me if I'm wrong, but what buyers will think is when you're being shopped, that's going to affect their credit.
No.
Right, because it's throughout that duration of time when they're looking for a home. What is it? Is it
30 days. 30 days. So the way this works for mortgage shopping process purposes, also works this way for car loans, by the way. When you apply for one, you have opened a 30-day window where any other application of that same type does not count against you. It's going to count as one credit pull. So if you go and apply with BB&T for a mortgage, you may as well go apply with every bank from here to Kalamazoo as long as you do it within that 30-day window, because it's all going to count as one credit pull. Now, here's what you don't do, and this is where people make a big mistake. If you have people that are close on qualifying, they go and they apply. Well, we can't give you a loan now, but you need to work on this, this, and this, and then you come back to us. And then a month and a half later, they go and apply somewhere else. Don't do that. That will kill your credit because you're now outside that 30-day window, so it counts as a brand new credit pull and application. That will absolutely harm someone's credit. Okay? So stay within that 30-day window. There is no potential harm to them from applying and shopping that thing around once they've already filled out one application, because you've opened that door. Okay? Everybody good with that? Good. Good. The secondary mortgage market. So that's all the primary mortgage market. What happens in the primary market? Loans are what?
Made.
Loans are made. Loans are shopped. That's where borrowers meet lenders. That's the primary mortgage market. The secondary mortgage market is the Wild West. The secondary mortgage market, there are no loans being made. Remember last night we talked about the fact that notes were negotiable? What did we say that meant? They could be what? Sold. That's the secondary mortgage market. The secondary mortgage market is where those notes get sold. It's where they get sold. And the reason they get sold is two things. Number one, the banks want their money back. They want it back in a hurry. Because they want to do what with it again? They want to lend it out again. Because remember, they got paid a bunch of fees when they wrote this loan. They got paid an origination fee. They got paid a credit report fee. They got paid a rate lock fee. They had collected a lot of money as a result of lending out this $200,000. Does that make sense for everybody? No, it doesn't make sense?
This part gets me.
Okay. How does it get you?
I'm just trying to understand the secondary mortgage market.
All right, well, so I'm going to give you the motivation. Bank of America lends you $200,000. Here's their problem. All right, they made $3,000 off of you today because you paid $3,000 in fees. You paid an origination fee, you paid a credit report fee, a rate lock fee, all this stuff, discount points. They made $3 grand off of you today. Well, that's great. But now how are they going to make money off of Renell?
They gotta wait 30 years.
They gotta wait 30 years. They ain't that patient. See, they'd rather make $3,000 in a day than make $800 a month. So, they want their money back. So what's the best way for them to get their money back?
Sell the note.
Sell the note to somebody else. And there are people willing to buy that note. There are people willing to buy that note sitting in this room.
So my loan is being sold to someone else?
Yes, absolutely. And probably multiple times.
So that means another bank? I belong to another bank too?
That means the note belongs to another bank.
And you're gonna get some paperwork from the other.
And that probably means that bank has sold it to somebody else. And that somebody else is probably not even a bank. It might be an insurance company.
Insurance.
And you're not even making payments to the person that owns your note.
That's right. You're
It's
still
a
making
separate
payments to
entity.
the original lender because They all recognize that you would be too confused to send payments to who you actually owe the money to, so they're paying the person who originally loaned you the money to keep collecting the payments. But you know what they're doing with the money? They're forwarding it along to who it belongs to.
Without my knowledge.
Without your knowledge. Well, they supposedly with your knowledge, they send you a form in the mail that says, congratulations, your note's been transferred to so and so and so.
Everything else they say, don't keep it.
Because I've been with Bank of America for what, almost 11 or 12 years.
I guarantee you Bank of America does not hold that paper. And not only do I guarantee you they don't hold it, they didn't hold it for 2 days after they wrote it. In fact, they probably sold it the same day you took the note out. I have been to Bank of America closings where the what does the word assignment mean? Changing the what? Changing the parties, where the assignment of mortgage was literally in the closing packet.
Oh,
I have literally been at a closing where you have sat there and they have signed the mortgage note, and then at the bottom of the pile, the attorney goes, by the way, your loan was just transferred to Mortgage Electronic Registration Systems. Here's your new lien holder right here. Well, it's literally been sold while we were sitting at the table
wow.
writing the loan. And so I guarantee you Bank of America sold that note. And I guarantee you whoever they sold it to has probably sold it again, most likely. And here's the motivation for the people buying it. The people buying it want to invest in mortgages because mortgages are viewed as a very safe investment vehicle. But the people who are investing this money in mortgages don't want to make the loans, because making loans is a pain in the rear end. Because to make loans, you got to find borrowers. You got to sit down, you got to take an application from them, you got to qualify them, you got to check their credit, you got to check their income, you got to look at their tax returns, you got to look at how much debt they got. That's a lot of work. Well, these investors who have cash don't want to do all that work. So they'd rather pay Bank of America for the note. So here's the advantage to Bank of America. They loan Renell $200,000. They make $3,000 in fees today off of her. Tonight, what do they do with that mortgage? They sell it to Patrice. Now, they sell that $200,000 mortgage to Patrice. They don't sell it to her for $200,000 though.
Yeah, how much?
What do you think they do?
201,000.
201, 202. They mark it up. Patrice pays 202 for it. So now how much has Bank of America made off of Renell's note? $5,000 in how long? A day. And what are they going to do with that same $200,000 tomorrow?
Oh, go use that.
They're going to lend it to Ivy. And they're going to make $3,000 off of her tomorrow. And then they're going to sell that note to Patrice probably as well. And make another, and they made $5,000 off of that money today. And then what are they going to do with it on Thursday? They're going to write another loan with that $200,000. Now do you get it? Does it make sense now?
$1 off of
But I'm still
$200,000.
paying to Bank of America.
Right.
Yeah.
They're just collecting the money. They're passing it along to its rightful owner. And by the way, they're making money doing that too. They're charging a fee to collect the payment from you. Because here's the thing, Patrice bought the note, but Patrice is like, I don't want to collect the payment every month. I don't know who this lady is. Oh yeah, I bought her loan, but I don't know who she is. Who has the relationship with you? Bank of America. You already set up on auto draft with them, right? So when Bank of America sells Patrice that note, they say, by the way, Patrice, we would be happy to continue to collect the payments for you. We'll just take 2% per month. How does that sound for you? You know what she says? Sure. So Bank of America continues to collect the monthly payment. They collect your monthly payment. They take their 2% cut. They send the rest to Patrice every single month.
So question now, on like the mortgage insurance, when it has lien holder, will it have my name or will it have Bank of America name?
It'll have whoever owns the note.
Okay, so
Whoever owns the note.
let's say they own the note, so even if I bought the note and the person forecloses.
Then you would be the lien holder because it's whoever bought the note.
So it will change.
Whoever owns the note, it would change. It would change on the mortgage insurance policy. The lien holder would change when the note was sold. Exactly.
That's what I'm saying. So people can tell, even though like she's paying Bank of America for her mortgage.
Oh, she can tell who's got her mortgage because she can go to the county courthouse and pull her deed of trust. She can pull her deed of trust, and her deed of trust will have been assigned over to the new lien holder. It'll have the original one over there, but they don't have an assignment on there to the new one. It'll show who the new lien holder is.
Will it track
And it'll
all
probably be some company she's never heard of. It might be some company we're going to talk about in just a second. Yes, ma'am.
Our mortgage is set up with this horrible company. Y'all ever hear Sinlar run? With the servicing company called Sinlar. So when I
Paulson loan, I know they're just a servicing company.
Right.
I asked them because it's been sold,
Right.
sold or whatever. So, who is the lien holder? They told me that they have no idea. That
They don't.
it's the servicing company.
They don't. They're just collecting the money.
So I can go online and pull up.
You can pull your deed of trust and you'll be able to see. You're looking for what's called an assignment of mortgage.
Okay.
An assignment of mortgage will show you who the current lien holder is.
And you stop paying it, you'll find out.
You'll find out who it is going to stop paying. That's one way to find out. It's not a recommended method, but you will find out because you will hear from them if you stop paying. That is for sure.
You gonna get the.
Renell, is that helping a little bit? Okay. So, the benefit of the secondary system is, well, the bank's going to make a lot more money because they can basically lend the same money over and over and over. But there's also a huge benefit to the consumer because there's a benefit to the second and third and fourth borrowers that they could go to Bank of America and get that loan. Because if Bank of America couldn't sell that loan, they wouldn't be able to make any more loans because they're out of money. Does that make sense? And so what you would end up with is a situation where some days the bank would have money to lend and some days they wouldn't. Because they'd have to be waiting for somebody to come in and deposit enough money to lend out. As it works now, they don't have to. Because the only thing they need to do to replenish their money is sell what? Sell some mortgages. They sell some mortgages, they get money back in the door, they lend it out again. And they just keep recycling. Basically, Bank of America's got like $3,000 to their name. They just keep recycling it over. I'm kidding, it's a little bit better than that. But they just keep recycling it over and over. Yes, ma'am?
So I'm trying to understand so Bank of America would lend the mortgage out every time. So when they lend it to the second mortgage holder, they can't sell it. The
What do you mean they
mortgage
can't?
holder can't sell it.
Yeah,
Sure,
they can
it
sell
can be sold as many times as you want.
So Bank of America can also sell it, and the second mortgage holder can sell it.
Sure.
So they can sell it at the same time if they want to.
What do you mean they can sell at the same time? Only one
Same
person
day.
owns it at a
Once they
time.
sell
On the
it,
same
they don't have it
day.
anymore.
Right, only one person owns it at a time. But yes, theoretically, you can both sell it in the same day. You can sell it to one early in the day, and then they can sell it to somebody else later in the day. If they find somebody willing to buy it and pay them more than they just paid for it, they will sell it. And that's how these things get marketed. Sometimes they can change 2-3 times in a day. Yes, ma'am.
So with that court thing, when you say you can go down there and see, check the deed.
Deed of trust.
Deed of trust. Does it have each person that has owned the loan?
You can look at every single assignment of mortgage along the way.
Every time it gets assigned, just
Absolutely.
record it
You
down.
can see every single one along the way. So you can know everybody who has ever owned that note.
Probably goes up in value as you pay your house off, doesn't it, because of the equity?
Well, yes, it becomes more valuable because it becomes less risky. The more equity you build, the less risky the note
They
is.
get their money back, it's default, they're
Right.
more down.
Right, so it's a less risky investment at that point in time. But also remember, the yield on it becomes less over time because as your principal balance goes down, you're paying less what? Interest. Most of the earnings are in the first couple years, the first few years. So that also has a detrimental effect on their selling it. That's why they like to sell them early on because that's when they create the highest yield. Okay?
Which is why they like to have the discount rate.
Which is why they love to get the discount points because man, if you do the discount points, you just gave them a tremendous yield right up front. Does that make sense? But it's going to make it harder for them to sell because they had to write the note at a lower rate, which makes it harder to sell because the investor doesn't want it because it's at a lower interest rate. Does that make sense for everybody? Okay. So the secondary market is where these loans are being sold. So if you had to answer the question, what's the main function of the secondary market, what would you say? Sell loans or replenish the money to get the money. How many of you buy mortgages? Do we have any mortgage investors in here? All of you should have your hands up just about. If you have a 401k,
That's right, you buy more.
if you have a Roth IRA, if you have any of those things, you buy mortgages. If you have a life insurance policy,
Yeah.
you're buying mortgages because that money's all being used to purchase mortgages in the secondary mortgage market. Yes, ma'am.
Okay, so since you said that, I need you to put on a different hat. So now I want you to be like a stockbroker.
Okay.
So when you say the 401k. So tomorrow, if I go to work, I should, or I could pull it now. When I go, regardless, I could check my 401k,
Portfolio,
yes,
Mhm.
to see who,
where the money's invested.
right, and switch it to more of mortgage-based investments.
You can,
because
which
that's
is gonna
what
switch
makes
it
the
probably to a lower yield because it's a safer investment. Mortgages are considered very safe, but for that reason, they're also very low return. You know, they're low risk, low return. So if you want your 401k to grow very predictably but very slowly, you keep it heavily invested in mortgages. If you want the bigger returns, you keep it more invested in the stock market, for example, in stocks and bonds. But there's more risk in stock than there is in mortgages with a greater return. More risk, more return.
So what you're saying is that the interest rate, like my interest rate is really, really low.
Yep.
They're not gonna, it's
Not as attractive? That is correct. It is not as attractive.
1.125.
It's not as attractive.
So they might still got to it.
It's not as attractive to an investor at that rate because, again, the only money they can make off of it is that low interest rate. So they might be willing to buy it, but they'd be willing to pay almost nothing for it, right? You know, the markup on it would be very tiny because of that.
So could they still actually have hers because of that?
It's possible. It's possible. It's always possible, but with Bank of America, generally, they don't keep any paper. They sell everything. They sell the desk if you buy it from them.
They probably looked at my side as interest.
Okay? Now, let's talk about the big player in the secondary mortgage market. Actually, big players. Fannie Mae and Ginnie Mae. Fannie and Ginnie. First of all, neither one of them are called actually Fannie Mae and Ginnie Mae. Those are just affectionate nicknames based on the acronym. Fannie Mae is the Federal National Mortgage Association. You don't need to know that for the test, but because of the abbreviation FNMA, it has traditionally been called Fannie Mae. That's where the name comes from. That's not the name of the company. The name of the company is Federal National Mortgage Association. Okay?
Did you say federal?
Federal. Federal. Not only did I say federal, I said Federal National. There's a reason it's named that. Fannie Mae is unique. In all of the history of American companies, Fannie Mae is unique. Fannie Mae was born out of the Great Depression. Fannie Mae is a private company, so you need to pay attention to this. It's story time, but it'll help you understand how the system works. One of the major causes of the Great Depression, not of the actual stock market collapse, but the reason the Great Depression became the Great Depression was a lockdown of the credit markets. You couldn't borrow money. Nobody could borrow money. Because at that point in time, banks only loaned out what they had on deposit. There was no real mechanism for them to sell their loans. So the only loans banks could make is if somebody had deposited enough money with them, then they would lend that money out. And the idea was that the bank would earn, that's why savings accounts pay interest. Does that make sense? Because the bank was lending out your money, they were making interest on it, and you got to share in that so they could put some of that interest back in your savings account and the bank kept the difference. That's the traditional banking model. Well, when the stock market collapse happened in 1929, everybody panicked. They wanted their cash. When people panic, they want their money in cash. Millions of people went to banks all across the country at the same time and wanted to withdraw their money. Here's the problem. Where was the money? It was tied up in loans. It had been loaned out. It wasn't there. Do people get slightly upset when they go to the bank and they cannot withdraw their funds? Yes. People were literally outside of these banks with pitchforks and torches and shooting bankers in the street. I mean, it was a mess. There was a run on banks nationwide. And so the bank's response actually created the Great Depression. It wasn't the stock market collapse that created the Great Depression. The bank's response was, well, we got to get these people their money. The only way they could get their money was to do what? They couldn't sell the loans. They called them due. All of them. They literally took every mortgage, every farm mortgage that they had, and they said, we need it all back right now. They called them all due, which was entirely legal at that point in time. Well, could those people pay all that money back in a lump sum? So what happened to them all?
They lost their property.
They were all foreclosed on. Millions of foreclosures in a several month period. What does that do to the value of real estate? It collapses it instantly. And not only that, when the banks did get this money back in-house, what did they immediately do with it? They couldn't. They gave it back to their depositors. So the bank still didn't have money to do what? To loan out. So these people who had all just been foreclosed on, even if they wanted to go buy another property, they couldn't find anywhere to do what? To get a loan. That's how a stock market collapse becomes a depression that lasts almost 20 years. Because nobody could borrow money to buy anything, and so that caused prices to continue to spiral downward, which caused even more people to get foreclosed on, and more people who couldn't borrow money. It just became, you see how that process just gets uglier and uglier and uglier. Does that make sense? So, as part of the recovery effort for the Great Depression, Congress created the Federal National Mortgage Association. Now, here's what you need to know about that. We are not a country where Congress creates companies. Companies are supposed to be what?
Private.
Private. And Fannie Mae is privately owned. That's what's so weird about it. It's a private company, but it was created by the United States federal government. Now, Fannie Mae was designed to do one thing: buy loans. The idea was that people would invest their money in Fannie Mae through buying stock. You buy stock in Fannie Mae, it's a publicly traded stock. And they would take that money and do what with it? Buy loans. And if Fannie Mae was buying loans from the banks, then the banks would have money to do what? To lend out. It would get the system moving again. Does that make sense? Congress figured, though, that the system would not get moving unless there was some jump start. There was no money to be invested in Fannie Mae. People weren't going to invest money in Fannie Mae until they could see that there was money to be made by investing in Fannie Mae. Fannie Mae couldn't prove it was worthwhile unless it had money to buy these loans with in the first place. Where do you think the seed money came from? The federal government. And not only did the first money come from the federal government, Congress, way back in 1939, came up with the idea that we need to make this so it doesn't happen again. We need to make it so that if the shit hits the fan, that Fannie Mae can continue to buy mortgages no matter what. Well, how do you make it such that a private company never runs out of money to buy mortgages? Give them the ability to do what?
No, keep giving them money.
Keep giving them as much as they need. Fannie Mae has the ability to borrow money directly from the United States Treasury. Unlimited sum. There is no cap. So, in the late 2000s when the mortgage market collapsed, do you think Fannie Mae collapsed along with it? It did. Its value did, because all these mortgages collapsed. They never stopped buying mortgages, though. Because when people pulled their money out and stopped investing in Fannie Mae, where did they cycle over to? Where did they start getting the funds from? The U.S. Treasury. And they continued to buy loans. Which is the only reason that you could go out in 2009 and get a mortgage loan. Because if Fannie Mae hadn't continued to buy them, no bank in this country would have had money to lend in 2009. Does that make sense for everybody? And here's the most interesting thing about it. I tell you, those people were smarter than we give them credit for. Fannie Mae borrowed $1.7 trillion. $1.7 trillion. A trillion is 1,000 billion. A billion is 1,000 million. That's a lot of money, folks.
Tractor trailer.
Fannie Mae borrowed $1.7 trillion from the United States Treasury to buy mortgages. How much of it do you think was repaid? Every penny. Plus interest. Every single penny plus interest.
From buying mortgages.
From buying mortgages. Not only did it recover, it's paid back every bit of that debt to the federal government. Is that a system that worked?
Yes.
Absolutely. We owe a debt of gratitude to those people in 1939 because that system worked exactly as it was designed to work.
Well, the point is, as long as people can keep living as they were already living, keep buying and selling. And
That's exactly right, to keep the system moving. Because here's what the idea is. In times of crisis, private investment goes away. The only place that can literally have unlimited sums of money is the place that prints it. And that's the thought process behind Fannie Mae. Now, I'm not saying that, you know, every government programs are great. I'm not even getting into that. But what I'm saying is that one worked exactly as it was intended. Does that make sense for everybody?
Is that the thing where, you know, during Congress, they all had to go and vote on whether or not they get...
That was TARP. Fannie Mae is separate from TARP. TARP was a bailout program for other things that were not covered under that kind of a program. Okay? But does that make sense for everybody? So, Fannie Mae continued to chug along. Now...
I got a question.
Yes?
How were the banks able to do that?
How are the banks able to do what?
Able to make everybody pay their payments.
Everybody didn't pay.
But I'm saying, didn't they have contracts?
Who is they? I'm not inside your head. You gotta give me more details.
The lenders, didn't the
With
lenders
contracts
have
have...
contracts with the borrowers?
Sure.
So how were they able to say, I need all the money for your purchase now?
You mean back in 1939 or 1929?
Yes.
Back then, there was no such thing as a contract. You went in on a handshake deal, you borrowed the money, and they just called it due when they called it due. And so what we've done is much more formalize the process now. And, you know, now the borrower has rights, the lender has rights, and so we've seen the error of that kind of system.
But you still said the other day, if you go three months behind, they could call it due.
Right, I mean, if you default, but these were people who never defaulted.
They just wanted the money.
Well, they didn't want it, they had to have it, because they had people burning the bank down to get their money back.
They couldn't see the ripple effect, all that.
Well, it didn't matter whether they could see it or not, they couldn't control it. You know, if somebody's got a shotgun in your face, what are you going to do? I'm calling somebody, no dude, I'm getting you your money today. You know,
but you the same one who's going to foreclose on your house now. I'm going to call your note dude.
Yeah, and that's what happened. It rippled all the way through. That's exactly right. Now, do we all understand Fannie Mae?
Yes.
Now, here's the thing. You got to understand about Fannie Mae. Because it's a private company, it's not designed to continually borrow money from the federal government. Like right now, it's not borrowing any money from the federal government. It's operating on its own because people are back investing in Fannie Mae. Well, you only invest in a company if you think the company's going to do what?
Make some money.
Make money for you. A company that buys loans can only make money when they buy good quality loans that people are making their mortgage payment. Does that make sense to you guys? I mean, foreclosures obviously would sink Fannie Mae if they have lots and lots and lots of them. So Fannie Mae only buys really high quality loans. That's their goal, is to buy very high quality. What makes a loan high quality?
The person who borrows the money.
The person who borrows the money is high. So what makes a borrower high quality? Good credit. That's part of it. Their down payment. That's the big thing. The best thing about a borrower that makes them trustworthy is how much skin they have in the game. The more of a down payment they make, the less of a risk they are. Does that make sense? So generally speaking, Fannie Mae only wants to buy loans where people have made a substantial down payment. Are you with me on that?
Yeah.
Now, the problem is that leaves a lot of loans out of the picture. And now the banks have gotten so used to being able to sell these loans that pretty much you won't find a bank in this country that will make a loan unless they think they can do what with it? Sell it. If they don't think they can sell it, they're not going to make it. There are loans that you can get that don't require much of a down payment. Well, the bank's not going to make those loans unless they feel they can do what? Sell it. So they need another outlet to sell those loans. Those riskier loans, they need somewhere else to sell those things. Enter Ginnie Mae. Ginnie Mae stands for the Government National Mortgage Association. This ain't no private company. This is the federal government. Ginnie Mae is the United States federal government. Ginnie Mae buys the garbage. Ginnie Mae buys the junk. From a lending standpoint, that doesn't mean the borrowers are junk. It doesn't mean they'll default on their mortgage. It just means they're more risky. And what makes them what's the primary thing that makes them more risky? They don't have much of a down payment. How many of you have ever heard of an FHA mortgage? Or a VA loan? Or a USDA loan? All of those are very risky mortgages because all of them require very little, if any, down payment. Does that make sense for everybody? Guess who buys those loans in the secondary market?
Ginnie Mae.
Ginnie Mae does. Here's the interesting thing. Ginnie Mae does not hold them for very long. Ginnie Mae turns around and sells them. Who do you think buys them from Ginnie Mae?
Ready?
Fannie Mae. Here's what's crazy about it. Fannie Mae won't buy them straight from the bank. But they will buy them from Ginnie Mae. You know why they will? Because they guarantee it. Ginnie Mae puts a guarantee on that loan. Ginnie Mae puts a guarantee that if it defaults, we will pay. And who is we? Who is Ginnie Mae? The federal government. So now that loan literally has a stamp of approval on it from the United States government that says this loan is backed by the full faith and credit of the United States Treasury. Are you interested in buying it now, Fannie Mae? What do you think?
Yes.
Absolutely. All of a sudden that thing just went from junk to gold, right? Because now it's got a stamp of approval with a guarantee from the United States federal government. How many of you have ever heard the expression a federally backed loan or a government-backed mortgage? That's why they're called government-backed, because they're purchased by Ginnie Mae and then that guarantee gets stamped on them so that they can be resold. That's the process.
So that's why Fannie Mae can afford to pay back that 1 point whatever trillion dollars
Yep.
that they had borrowed from them because they were going to buy these guaranteed loans that the government was backing anyway.
That's right. So when they failed, they still got paid on them.
Then they pay the government back.
So
So either way,
With the government's own money. There you go. Now, but here's the thing. Here's what you have to understand about Ginnie Mae. It's not a public service that they buy these loans and guarantee them. They charge these borrowers tremendous mortgage insurance premiums for that guarantee. That guarantee is called mortgage insurance, and the borrower pays for that mortgage insurance. So when you get an FHA loan and you pay your mortgage insurance, who are you actually paying the mortgage insurance to? The federal government. Because you're paying the federal government to guarantee that loan.
Not the insurance company.
Not a private insurance company, you're paying it straight to the federal government. It's the federal government who's insuring. The federal government's not making the loan, but they're insuring the loan.
So it's just like the the Bank of America situation. She's paying Bank of America, but they're not actually holding the notes. So that's the same situation in this. I'm paying State Farm, but it's actually going towards.
No, you're not paying. You're paying directly to the federal government. With FHA mortgage insurance, it's going directly to the federal government. You're paying it to your lender, but then they are sending it straight to. You're paying it as part of your mortgage payment, but then it gets sent straight to the federal government.
So just because I picked the company State Farm.
That's not mortgage insurance. That's your homeowner's insurance.
Okay.
That's a whole different kind of insurance.
Okay.
Yes.
So now with them paying the insurance to the government. So with that, you getting the lower down payment, but you basically giving it all back through the
You're paying a higher monthly payment because you're paying mortgage insurance.
through the mortgage.
Yeah. Lower down payment, but higher monthly payment.
So, question, so why has it always been assumed that USDA and VA loans were good loans? Like,
Well, they are. They're great loans for people who can't get anything else.
well, I mean, usually when I think of USDA or VA loans, people who are in service, or people, that's not.
And again, they're great if you can't get anything else. They should always be a last resort, though, because they're very expensive, because that mortgage insurance on them is very expensive. Yep.
And me being private service, a lot of times you do think of that VA loan because you think of most, service members, a lot of times may not have a big amount saved up for a
Right.
large down payment. So at least you can still
And
get
that's
a
why
house.
it's a great loan program for those people, because if they don't have a down payment, they're not gonna be able to get another type of loan. And so that's why it's a great program for them. But if somebody's got 20% to put down, they're not a good candidate for a VA loan. Okay? Does that make sense for everybody? Okay? You understand the basic difference between Fannie and Ginnie? Yes, Michelle.
What if somebody does secretly have 20% to put down, but they want to go ahead and try to get a VA loan because they think that because they're in the service, the VA loan is going to benefit?
Why would they have to do it secretly? They can get a VA loan if they want a VA loan, but they're just gonna pay hellacious fees every month for that mortgage insurance.
So it wouldn't make sense.
Correct. That's exactly right. It's not about what they can do. They can do it if they want to. It just doesn't make sense for them to do it.
Gotcha.
Because they're going to pay a bunch of fees for the mortgage insurance every month. Okay? Now,
Yeah,
because it doesn't exist anymore. It's no longer tested, doesn't exist.
Oh,
Freddie
Oh,
Mac.
cut Freddie off?
The whole purpose of Freddie Mac was to purchase loans by credit unions and savings and loans, but it's been in government conservatorship since the meltdown and never has come out.
2008?
Yeah,
It went out?
and never came back.
So it's not on our test.
No,
yeah.
nope. As long as you're familiar with Fannie and Ginnie, you are good to go.
So did
So ultimately, where are the vast majority of loans going to end up in the hands of? Fannie. It's either going to buy them directly, or it's going to buy them after they've gone through Ginnie and gotten that guarantee stamped on them. Okay. Yes, ma'am, Marla.
So, the Freddie, even though we don't even talk about it too much, but Freddie Mac, all those loans went back under Fannie Mae?
Eventually, yes.
Okay.
Yeah, the federal government had to guarantee them and then pawn them off, whatever they could do. And gradually they're trying, Freddie's no longer purchasing, so what they're doing is trying to work that portfolio down to nothing, eventually. Okay? Subprime crisis, all right? The term subprime you need to be familiar with. A good, solid borrower is a prime borrower. So what do you think subprime means?
It's not
It means they are less than desirable as a borrower. So what kinds of things and maybe combinations of things would make somebody less than desirable as a borrower? You left out the most important one. No down payment. That's the first red flag about a subprime borrower. They don't have money to put down. I'm going to tell you something, folks. If somebody's got 50% to put down, you don't care what their credit score is. It'll be a negative 800 and you'll still make them a loan. Because if they got 50% to put down, there's no way you can lose on that loan. If they don't make a payment, you foreclose, you sell it, you get your money back. Does that make sense for everybody? So there's no risk involved. So the first thing you look at as far as risk profile on a borrower is down payment. So subprime borrowers are almost always going to have low or no down payment. Now get to the other factors. What else? Bad credit, no credit, poor payment history. All of those are true of subprime borrowers.
The first time?
Reverse mortgages? Yeah, reverse mortgages. So a reverse mortgage just means you are, rather than making a payment toward a loan balance, instead of taking a lump sum money and then you make payments back every month, you're taking a payment from the bank every month. So you're borrowing the money in slow drips.
So, I know somebody who retired and they put like a substantial amount of money down and said, I don't have to pay any mortgage anymore. Does that work? So that was confusing. He said he didn't have to pay it anymore.
They're actually sending him a check every month, I would imagine. But he's tapping the equity of his house. And so if he lives long enough, he got to go.
Yeah, he owe all that back.
Right, that's what I was saying. So
Because eventually that equity will get tapped. If that equity gets tapped out, he's out.
So like even if he passes, him or his wife passes, and he is.
They got to pay off that note.
Yeah.
That's what I'm saying. Let's take it back.
They got to pay off that note because you're borrowing against the, every month when that check comes, you're borrowing more against the property.
Now he can't send it again though, right?
He can make payments back if he wants to. Most people that do that, if they don't have enough money to live on from month to month, but they have enough equity in their property, they do that to basically live off of the equity.
But it seems like, I mean, from what you're saying, like, it seems like it's more geared towards elderly.
It is. Reverse mortgages are. Because the whole point is you need to die before you finish tapping the equity of that house. I mean, that's the blunt truth. If you think you're going to live a long time, you shouldn't do a reverse mortgage. You know, because you're going to run. Because what happens when you tap the equity? When the equity tap is dry, you've got to leave the property. Now you're homeless and you don't have any money. So you really need to make sure you're going to die first. It sounds terrible, but that's the truth
How
of
long are you supposed to, yeah, so I was going to say, how long is it supposed to be, what, 10 years?
it. It depends. They can be structured for 10, 20. Yeah.
It's literally kind of just raping the seams.
It is in a lot of ways.
Because they don't
Yeah.
even really know. It's not-
I mean, it should be, again, that should be one of those things, should be the last thing they consider doing.
Yeah. A lot of them don't plan on leaving their homes to their children either, some cases.
Well, and they probably aren't going to leave it to their children in that case because there's going to be so much debt against it that it's going to have to be sold.
They're gonna eat up all the money.
Yeah. Okay? Different types of loans. You're going to see this on a test. The conventional mortgage loan. Conventional always means normal, the norm, the accepted norm. In this case, it means not risky. You ought to put that in your notes. Conventional loans are not risky loans. These are your highest quality loans because they are made to your highest quality borrowers. What did I say was the first thing that makes somebody a high quality borrower? Down payment. These are people who have a substantial down payment in most cases. In addition, they're people who generally have better credit, better income, more established history. These are going to be the conventional loans. But none of that, those are all characteristics of a conventional loan. That's not the definition, and you need to know the definition. The definition of conventional loan is quite simple. It's not backed by the federal government. So remember when we talked about Fannie Mae only buys the best of the best? What do you think we call that best of the best?
Right.
Not backed by the federal government.
They're not backed, but what's the name of them? They are conventional mortgage loans. These are the loans that Fannie Mae is buying directly. And the reason Fannie Mae is buying them directly is because they're the least risky. And what made them the least risky? Somebody put down what?
A lot of money.
A lot of money. And that lot of money, the traditional amount is 20% down. So what loan to value ratio is that? If they put 20% down, the loan to value ratio is what? 80%. So that means they're generally not borrowing more than 80% of the value of the property. Does that make sense for everybody? Okay? That's a conventional loan. It's not guaranteed by the government. And the reason it's not guaranteed by the government is it doesn't need it. It doesn't need any guarantee because we feel very safe and secure that this loan is going to get paid back. Does that make sense for everybody? Okay? Now, as I said, they're made to the most qualified borrowers. And generally speaking, the loan-to-value ratios are going to be lower, like 80% or less. The lender wants to see that that borrower's got skin in the game. They can be higher than 80% loan-to-value. If they are, though, lenders get nervous. So you can have a conventional loan. What did we say the definition of conventional was?
Not backed.
Not backed by the federal government. I can have a 90% loan-to-value conventional loan. Now, that means it's not backed by the government, but it also means they only put down how much? 10%. Does that feel a little risky to you? Yes, that's risky. I'm worried now that I might not get my money back. If I'm Fannie Mae, I'm not buying that loan unless the borrower makes me feel better about it. How do you think a borrower could make Fannie Mae feel better about this thing?
Buy discount points?
Not buying discount points. Buy what? Insurance. Buy an insurance policy that if you default, we'll get our money. We call that mortgage insurance. Yes, ma'am.
But I thought that was automatic. But that's only if you don't put down 20%.
You thinking it's automatic, you're not understanding the system.
Okay.
It is automatic because the bank's not going to make you a loan unless they can do what? Unless they can sell it. And Fannie Mae's not going to buy it unless it's what? Unless it's insured because you didn't put enough money down. So yes, it is automatic, but it all flows from the fact that Fannie Mae won't buy it because you didn't put enough money down. And so the only way they're interested in buying it is if you also put insurance on it.
Insurance on it.
So when you go to the bank, they say, yeah, we can get you a 90% loan, but you're going to have to get what? Mortgage insurance. Because they know the only way they're going to be able to sell that loan to Fannie Mae is if it's an insured loan at that point in time.
So is this additional mortgage insurance because the loans are automatically have the mortgage?
No, loans do not automatically have mortgage insurance.
Well,
What do you mean, well?
Because if you put down 20% or more, they don't need mortgage insurance, right?
That's exactly right. If you put down 20%, there's no mortgage insurance.
Oh, okay.
Because you don't need it.
You don't need it.
Because there's no risk there.
Okay.
Private mortgage insurance. That's exactly right.
I'm used to dealing with the lower people.
Exactly. You're used to dealing with people who don't have a what?
Enough down
A
payment.
down payment. Those people are always going to have mortgage insurance because by very definition their loans are what? Risky. And so Fannie Mae doesn't want to buy that 90% loan to value loan because they see it as risky. Unless you can take the risk away from them. And how do you take the risk away from them?
By buying mortgage.
Buy an insurance policy. We call that private mortgage insurance. It's called PMI, private mortgage insurance. You get private mortgage insurance on a conventional loan. Now, I got these little thermometer gauges here for you to give you an idea of how mortgage insurance works. Sure.
You don't have big down payment, but you have more than half of the equity in the house.
What do you, wait a minute, your down payment is your equity.
And here, well, I own a home, I let one of my daughters live there. She has more than half of what she has over, house is worth $200,000. She has $130,000 equity in the house.
Okay.
So when she purchases it.
What do you mean when she purchases
She's
it?
gonna buy it from me.
Okay.
She won't have much of a down payment, but the equity.
How's she going to have equity? Because you're going to sell it to her at a
I'm
discount?
selling it to her for what I owe on it.
Then she doesn't have equity. Not in the eyes of the lender. Because when we talked about that loan to value ratio, what did we say was going to be used? The lower of either the appraised value or the what? Purchase price.
Yep.
So from their perspective, she's doing 100% loan to value loan.
Wow, interesting.
Because they're going to use the lower of. Now, what would make more sense is for her to do it as a refinance, because if she buys it with the high risk 100%, she can probably refinance it, because generally speaking, when you refi, they will consider what equity you have at that time. They actually get just the appraised value because there's no sales price to compare it to.
How does she refi if she doesn't own it?
Well, she'd have to buy it and do the 100% loan to value loan and then refinance it. So she's going to end up paying twice for the financing probably, but that might be the only way to do it without mortgage insurance.
Ouch. Wow.
Okay?
That's nasty. I never, yeah.
Okay? So, when you talk about mortgage insurance, think of it like this gauge. If we've got a low loan to value, do we need mortgage insurance? If we've got a low loan to value, not low down payment, low loan to value.
Yes.
Do we need mortgage insurance?
Yes. No, low loan value.
No. Low loan to value. I did not say low down payment. You need to get in your brain that loan to value is the opposite of down payment. If I have low loan to value, I have a high what?
Down payment.
Down payment. If I have a low down payment, I have a high loan to value. So if I've only borrowed, say, 50% of the value of the property, is there any risk here for the lender?
No risk.
No. So are they going to require me to buy mortgage insurance?
No.
No. How about if I go up to 80%?
You medium risk.
And I'm medium risk, but that's right up at the top of where the lender says you're okay. And so they're not going to require me to buy mortgage insurance. What if I go up here to 100% loan to value?
They're going to require.
They're going to require it. They're going to require. Does that make sense for everybody? Now, here's what you need to understand. This part right here doesn't get insured. You got to get this or you won't understand mortgage insurance. This part is never going to be insured because if you only borrowed this much, they wouldn't make you do what? They wouldn't make you buy insurance on it at all. See, if you were only borrowing up to here, what would they make you do about mortgage insurance? You wouldn't have to have it. Nothing. So, you don't buy mortgage insurance on this. You buy mortgage insurance on anything above this. So when you look at this loan, this is an insured loan, but is the whole thing insured?
Yes.
No.
Just the part above 80% loan to value is insured.
But I thought that was.
Just the part up here is insured. Because if you had only borrowed this much, you wouldn't have needed what at all? Insurance at all. They only make you insure the risky portion of the note. You don't buy mortgage insurance on the whole note, you buy it just on the riskiest portion, which is the portion above what?
80.
Above 80% loan to value. So if you do a 95% loan to value loan, what percentage of the value of the property is insured for the lender?
15%.
15%. The 80% remains uninsured, the 15% is insured.
And that's
Five gave you money.
That's the risk.
so we get.
Because that's the only part that's risky.
So it's
The 80% is not risky.
because we got that 80% from the bank.
No, you got it all from the bank. How's the bank going to get their money back if you don't pay them? See, you're not tying it together with the F word, and I don't mean the four-letter one. What F word matters here? See how disconnected you are? Foreclosure. Isn't that how these lenders get their money back, folks?
Okay.
That's what makes it risky when they've loaned more than 80%. Because if they've only loaned 80%, they know they can foreclose on it and do what? Get their money back. Because they can foreclose on it, sell it, and they know they're going to get their money back because they've only loaned out 80% of what the thing is worth in the first place.
Okay, so if they take a low amount at the foreclosure, it won't matter
Because they got that cushion.
they got the cushion.
They got that cushion there. Does that make sense? See, over here, they don't have any cushion because they've lent out how much? 100%. So they need to insure that risky piece. Yes?
So, I guess going back to that other example, if the house appraises for $300,000 and you're borrowing $240,000, aren't you already in that 20% cushion?
Well, you tell me.
I think yes. Because if the lower figure that you
What's 80% loan to value on $300,000?
It's 240, 60,000?
$240,000. So how much you say you were borrowing?
It's 240,000.
So then you're-
right in the margin.
You're right there. You're at 80% loan to. You're at 80% loan to value.
Come into play in that
That's what loan to value is. Loan to value is the opposite of equity.
Okay.
If we're at 80% loan to value, what equity are we at?
Because we had that example earlier and I got confused because this one I went, and I was kind of thinking about that.
Yep. But again, you're not thinking of it in the way the lender does. At the time of purchase, what is the opposite of loan to value ratio? If the loan to value ratio is 80, what's the equity?
Down there.
20. It has to be.
Difference.
It's the difference.
Because I'm thinking on the end, if they have to sell the house, they get.
Stop doing that.
Okay.
Stop.
All right.
Stop.
Okay.
Just stop. It's about right now when we're purchasing this property, when we're making this loan. Yes, ma'am. Trudy.
So with the example she gave about her selling the house to her daughter and the equity being high, would she need to change the purchase price?
She can't fix it. Stop worrying about that example. Get it out of your mind. It's not a good one because it is leading you down. It's a great question to go have a beer and talk about. It's a terrible question. I don't mean that in a negative way in this context because that's not how the questions are going to be presented on the exam. These are very simple, straightforward things. And you're asking questions that have nothing to do with, and you're doubling down on them. Don't do that. I told you to leave it, right? When you buy, you make a down payment. That is your what?
Equity.
Equity. If you don't make a down payment, how much equity do you have?
None.
0, which means your loan to value is what? 100%, which means you are a ultra high risk borrower, which means you're going to have mortgage insurance. It is that simple. That's right. That's exactly right. And listen, I really do like those kinds of questions, but on this sort of thing, we have to keep it on the straight and narrow because that's the way the questions are going to be presented on the exam, right?
So ultimately for me, the only thing I need to focus on is that the PMI, the mortgage insurance purpose is to make sure the lender can get paid back.
If the loan defaults.
And they don't lose no money.
That's right.
And if it's below 80%, they're not worried about it because they could foreclose. If it's above 80,
they're worried.
They're worried, and you got to make up the difference through the insurance.
That's exactly right.
That's correct.
That's exactly right. That's exactly right. So we're only insuring the risk above 80% loan to value. Yes? Patrice, do you have something? Oh.
No, we were just talking about like the fact that that 20% mortgage, how the banks look at it is the fact that they know 80% if, say, they can sell it and they have that equity there, the loan to value. The mortgage insurance is basically buying that guarantee that they're going to get their money, and then even after that, if they sell it, they make the money on top of that. So that's pretty much what they.
It makes them feel safe and comfy about it. So then now they'll buy it.
They don't mind taking a risk.
Because they're not taking the risk. Who's actually taking the risk? The mortgage insurance company is. The mortgage insurance company. Why do you think all the mortgage insurance companies were the first ones to go out of business in 2008 when the market collapsed?
Ah.
Because they had all the risk.
But see, that's the thing about it, knowing why something is present is just as important knowing that it's present.
That's exactly right.
You hear about PMI, you hear the word, but
That's
you
right.
don't know what it means or what's the purpose
It's
of
there
it
to
or what
protect
it
in that
does.
high risk situation. That's it. Okay? So, again, when borrowers want to go more than 80% of the value of the property, they can, but that's going to trigger them having to purchase what?
PMI.
PMI. Now, it's only called PMI if it's on a conventional loan. Okay? It's called PMI if it's on a conventional loan. There is mortgage insurance on the government-backed loans, but we don't call it PMI because it's not coming from a private company, it's actually coming from the government on government-backed loans. But when we're talking about conventional loans, the kind of mortgage insurance you get is called PMI. Generally speaking, PMI is cheaper than government mortgage insurance. Yes, ma'am.
So does every bank have PMI or no? I mean, like, does every bank have to have PMI for that risk?
Does every bank, the bank doesn't have PMI.
But does every bank?
Do they
like,
require
yeah, do
PMI?
they require it?
They don't have to, they can do whatever they want to, but they can't sell the loan unless they what?
Yeah.
Unless they require you to buy PMI. And they're not going to make the loan unless they feel that they can do what with it?
Sell it.
Sell it, so what's the answer ultimately
Well,
going
I'm
to
just
be?
thinking, because like, state employees doesn't have it.
And guess what state employees does not do? They don't sell their loans. And that's why they can make that choice, because they don't sell their loans. You see that? Does that make sense now?
Yeah, that's all.
Yep. They can make that choice because they're not selling their loans. And they really can't sell their loans because they're lending out 100% loan to value with no mortgage insurance, and so Fannie Mae would not touch them. Won't touch
That's
them.
also, like you said earlier, they get you out of their house quick too.
That's right. That's why they move so quickly. Yeah. That's why they only do ARMs, because again, it's a way to offset the risk, and yeah, they want you to keep it turning.
When I go into the credit union, and I know you said that they have the pictures up there that says for sale, what about the ones that say for rent?
That's probably ones that they own through foreclosure as well, and they just are trying to get revenue moving through it. Yeah. They've come into ownership of it. Okay? So now let's talk about the government-backed loans. Move away from conventional, because remember, what was the definition of conventional? I have to circle back and remind you. What was the definition of conventional? They're not government-backed, so now we want to go to the other side, which is government-backed. All of these are government-backed loans. The first example of a government-backed loan is the FHA loan. Right? Now, here's what I need to really get into your brain about these, because this is going to show up as a test question and people love to jump on it and it's wrong. the government doesn't make loans, folks. FHA does not lend money. When we talk about VA loans, VA does not lend money. Who lends money?
Banks.
The banks do. Who sets the interest rates? The banks do. FHA doesn't lend money. FHA doesn't set interest rates. What FHA does is provides the mortgage insurance. They are a mortgage insurer because the FHA loan program is a very high loan-to-value loan. As a matter of fact, it's a 96.5% loan-to-value loan. So FHA borrowers can borrow up to 96.5% of the value of the property. So do the flip side of that. How much do they have to put down? 3.5%. The FHA loan is a 3.5% down payment loan. Is that risky?
Yes.
Yes, exceptionally so. Does that make sense? Because that borrower has very little skin in the game. It is so risky that Fannie Mae will not touch it unless somebody puts mortgage insurance on it. But here's the problem. It's so risky that private mortgage insurance companies won't put mortgage insurance on it. So who's left to insure this thing? The federal government. And so the federal government is insuring this loan. That's why we call it a government-backed loan. The federal government, the FHA, is insuring this loan. Now, just like you pay a private mortgage insurance premium, if you got private mortgage insurance, you pay an insurance premium to the federal government for FHA mortgage insurance. And it's expensive. Significantly more expensive than private mortgage insurance is. And why do you think it's expensive? Because it's what? It's higher risk. This is a higher risk loan, so you're going to pay more for the mortgage insurance. Does that click for everybody? Okay. Now, it's still not fully backed. That's going to show up on the test. Don't jump on that. There's no such thing as a loan that is fully guaranteed or fully backed, because the first 80% is never what? Insured. What percentage is FHA insuring here?
Between the 3.5.
Not 3.5,
and the 80%.
16.5. They're insuring the amount above 80% loan to value. This is a 96.5% loan, so they're insuring from 80 up to 96.5. That's what the insurance covers. That's the portion of the value of the property that they cover. So just to give you an example with numbers so you can see what I mean by that. And I'm going to use $100,000 because it makes for easy math where you can just kind of see what's going on here. So let's say we got $100,000 property. Everybody okay with that? And the borrower takes out an FHA loan. So what loan to value is that loan written at? 96.5. So times 96.5%, they're going to lend $96,500 as the loan amount. Does that make sense for everybody? Okay? Which means the borrower is going to have to put how much down? $3,500 down. See, you add those two together, that adds up to the $100,000. Everybody okay so far? Now, here's how the loan's going to break down. The 80% loan-to-value piece is uninsured. So, $100,000 value of the property times 80%, that's $80,000 that's uninsured. Everybody follow me on that? How much was loaned out? 96.5. So the difference between those is what the insurance is going to cover. So in this case, what is the insured amount with the FHA insurance? $16,500 is the insured amount. Does everybody follow me so far? Okay, so that's what the insurance is on. So let's say that the borrower defaults. The borrower defaults, okay? and the property sells at the foreclosure auction for $87,000. Property sells for $87,000. Does that make sense? Is everybody okay? Now, how much of that is, how much of the value of the note was uninsured? 80,000, right? Which is 80%. Did we get the uninsured portion back?
Yes.
We did. So we don't have to worry about that. Does that make sense?
Yes.
Now, here's the problem though. How much were we owed? 96.5. Okay? Well, and how much was insured of that? 16.5. Well, if we subtract the 80 that was uninsured, we're left with $7,000. So we only got $7,000 back of the 16.5 that was uninsured. Does that make sense for everybody? So we're going to submit a claim to the federal government for $9,500 in mortgage insurance. That's what's going to be covered as a result of that foreclosure. That's going to be the payout from the mortgage insurance. Because if you add that $9,500 back in to their money, it makes them whole. Does that make sense? So they got all their money back.
So they'll get it, they'll automatically get it.
They'll automatically get it because it's coming from the federal government. They'll just, as soon as the foreclosure sale goes through. Now here's the interesting thing, and this is where it is an advantage to have mortgage insurance. Guess what that borrower is not going to have following them around any longer? A deficiency judgment. Because there is no deficiency. Because the borrower is buying insurance to cover that default so that the lender was made whole. There's no deficiency. The lender didn't lose. There's no deficiency, so there's no deficiency judgment. Does that make sense for everybody? That's how that mortgage insurance is going to work. So on a test, don't say that the loan is fully guaranteed by the FHA. It's not fully guaranteed. A portion of it is guaranteed by the FHA.
And is it going to have options like 80% or 96.5?
No, you won't. You will need to know it's a 96.5% loan to value ratio. But as far as what percentage is covered by the insurance, they wouldn't ask that question.
Okay.
I just thought it might help for you to see the numbers to get a better feel for how the insurance actually works.
Yeah,
Is it technically possible that the lender could still lose even though this is an insured loan? Yeah.
Especially if the foreclosure don't bring that much money.
What happens if this is $77,000? Is the lender taking a loss there?
Yes.
Yes, because they're going to submit for the full insured amount of $16,500, but when you add $16,500 back to $77,000, you don't end up with $96,500. So they still could take a loss. It's just very unlikely that they would.
And plus the loss is not as much.
It's very small. That's exactly right. It's very unlikely they take one at all, and if they do, it'll be a very small one. Okay, is everybody okay? All right, so that's the FHA loan. Now, FHA loans, these are some criteria you need to know that they might show up on a test. Number one, they're always 30-year notes for your purposes on the test. They're always 30-year fixed rate notes. They require what we call owner occupancy. What that means is that you cannot purchase that property and immediately do what with it? Rent it out. They require you as the borrower to live in the property. If you don't, that is loan fraud. That is a felony. Okay? As I said, FHA does not set interest rates. It's got to be appraised, and you have to use an FHA-approved appraiser. There's no prepayment penalty, and it is fully what? Look at that bottom, not fully insured. Fully assumable. FHA loans, like all government-backed loans, are fully assumable loans. So that means they must be assumable, which means they would not have what clause in them? What clause did we say last night?
Acceleration.
No, acceleration accelerates the due date. It's the other A one. About alienation. An alienation clause would prevent assumption. So you would not find an alienation clause in an FHA note. Yes, ma'am.
Back to the unable to rent it out. I guarantee, well, I don't want to say guarantee you, but are there people that's probably renting out their home?
Oh, of course there are. People break the law all the time. But what I'm telling you is, the reason I point that out to you is, number one, it can show up on a test. Number two, if you are the real estate broker and you know that they plan to use it as an investment property and you allow them to get an FHA loan, you are participating in the loan fraud and you are guilty of a felony. So my point is, you need to know that rule, so if you overhear a conversation about them planning to rent that thing out and you know they're getting an FHA loan, you got to go, whoa, no. You can't do that. You have to stop it.
What if they say they want to rent out a room that's still rented?
They can do that because they're owner occupants. As long as they're going to live there as an owner occupant, they can. That's okay.
Now, do they have to live there the whole time, or is it a certain amount of time?
No, a certain amount of time. It'll specify in the note. It's usually 5 years. It's usually 5 years of owner occupancy. Some of them say 3.
Okay.
But it'll be specified in the note. Okay? And the reason for that is investor loans are riskier. People are more likely to default if it's not their house. Does that make sense?
That's right.
So they want to make sure that they're not making more risky loans than they think they're making by lending out to investors with this kind of a loan program. They want investors generally to have more skin in the game, more down payment, because they're riskier. You do need to know that the most common type of FHA loan is the 203B. I don't know of any catchy way to remember that. It's just the 203B loan is the single family FHA residential loan. It's not used for condos though. That you do need to know. The 203B is used for anything residential other than condos. So single family houses, townhouses, any of that would be the 203B loan. Condos have a special FHA loan program because they're riskier. Condos are riskier. So theirs is called the 234C. C stands for condo. That is easy to remember. So the 203B is the generic FHA loan. The 243C is the condo version. It's much harder to get a 243C than it is a 203B as a borrower. I'm sorry?
You said 234C.
C. It's much harder to get the condo version because condos themselves are riskier. They look much more closely at the borrower for the condo version, and they also look at the condominium development. Not every condominium development will qualify for FHA lending. They look at how much they have in cash reserves and all that kind of stuff. Yes?
Because, you know, I mean, people, they building these condos, and a lot of places, a lot of condos.
Yep. And a lot of them don't qualify for FHA financing. Because one of the requirements of FHA financing on condos is that you have to have at least 50% owner occupancy before you can do an FHA loan. So when they're brand new, then there's nobody living in there yet. You can't do FHA loans on the condos.
What?
That's right.
So then they got to go to what?
Conventional, which means they got to have more of a down payment.
More of a down payment.
Yeah.
Wow.
So it takes a while before condo development gets stable enough before FHA loans can be made in there.
And they got to have 50%.
Owner occupancy.
Wow.
Yep. Yes, sir.
Did you mention what the loan to value ratios go up to on conventional loans? Is it 95%?
Well, you can have technically 100% loan to value. There's no cap on it, but what's going to dictate that is what will a private mortgage insurance company insure? What kind of risk will they insure? If you can find a mortgage insurance company that'll insure 100% loan to value, then you get a 100% loan to value conventional loan.
You know, long time ago we used to work in mortgages. Back in the day, they used to do those 125% refi loans and all that. Do they had to have the PMI and all that too to get to that 125?
Yeah, right. Absolutely.
And they would do all of that amount.
They would.
Would be part of the PMI.
Which is obviously super risky
It's
when
super
you're lending
risky.
out far more than the value of the property. Yeah. Yeah. VA loans, again, we're still on government-backed loans. These are not different very much at all from FHA loans. Pretty much all of the same rules apply to VA loans as apply to FHA loans. Especially that VA doesn't make loans. And VA doesn't set interest rates. Who makes VA loans? Banks do. Who sets interest rates on VA loans? The banks do. What does the VA provide? Same thing FHA provides. What? Insurance. They insure the risky part of the debt, just like an FHA loan. The only difference is how risky. VA loans are even riskier than FHA loans because VA loans allow up to 100% loan to value. How much of a down payment did you have to make on an FHA loan? 3.5%. How much of a down payment do you have to make on a VA loan? Zero. Zero down. So that is the advantage of being a veteran. Thank you for your service. We'll save you the 3.5%. That's it. Because other than that, folks, this is an FHA loan for the most part. It's very similar. It works exactly the same. They still have to pay for mortgage insurance. It's still expensive mortgage insurance. They call it a funding fee, but it's still mortgage insurance.
But aren't VA loans harder to write versus FHA loans?
Why do you think they're harder to write? They're riskier. They have a higher risk profile because they're 100% loan to value. And so the answer to your question is, yes, they are harder to write. The reason they're harder to write is because they're higher risk. The higher you go up that risk tree, the more that's going to be involved with underwriting that loan. Remember I told you, 50% loan to value, I don't care what they look like, what kind of credit they got, because we got the equity, we know we're good. 100% loan to value, we're turning over every stone. We want to know what their 4th grade teacher has to say about them. You know, I mean, we've got to do our homework on that because that's a risky loan. Some characteristics that you need to know for the test. This is one that is very unique on VA loans. On a VA loan, the sales price cannot exceed the appraised amount. In other words, if the property doesn't appraise, you have to let the buyer out of the contract, no matter what. Now normally, think about the offer to purchase and contract we use in North Carolina, that standard offer to purchase and contract. Is there any contingency in there about appraisal? There is no appraisal contingency in there. You have a due diligence period and you can terminate for any reason during the due diligence period, but you would not get what back? Your due diligence fee. And if you went past the due diligence period and you had to terminate, you would also lose your what? Your earnest money. If it's a VA loan and it doesn't appraise, you have to let the buyer out and you have to give them every penny of their money back. Or you can reduce the purchase price to the appraised amount. It's the only loan that has that requirement. And that's there to protect the borrower. Okay. So as a seller in a market like this where things are routinely not appraising, should you be maybe a little leery about accepting an offer that uses VA financing? Because if it doesn't appraise, you just lost. You either lost the deal or you've got to do what? You got to lower the price. One of the two. You got to lower the price or lose the deal and start over.
So you saying in a market like this they're not doing appraisals?
No, I said in a market like this, as a seller, you should be very reluctant to accept an offer that uses VA financing because there's a pretty high likelihood that property's not going to appraise.
That's how you want it to.
Not going to appraise means not going to appraise for the sales price.
For the sales price.
Right. And if it doesn't appraise for the sales price, then the seller doesn't have a choice. They either have to let the buyer out and give them all their money back, including their due diligence fee, or reduce the price to the appraised amount.
Will you get that information up front, that they're VA loan up front?
Yes, that's a material fact. Remember, one of the material facts is the ability of your client to complete the transaction. So when you're making an offer for a buyer, it's a material fact how they intend to pay for the property.
And that ain't discrimination against the vets?
They're not, veterans are not a protected class. So even if it was, it wouldn't be protected.
Yeah.
Okay, does that make sense? all right? As far as who can get a VA loan, because that's certainly going to show up as a test question. Who can get one? Well, what's the obvious answer? Veterans. Veterans can get them. Here's what's interesting about them, though. Anybody can assume them.
That's right.
You do not have to be a veteran to assume a VA loan. And just like every other government-backed loan, they are fully assumable loans. So you have to be a veteran to take out a VA loan, but you don't have to be a veteran to assume a VA loan. But that might have a negative implication for the veteran. See, veterans have what's called an entitlement. You need to know that word. An entitlement to that VA loan. And that entitlement, it's like a token. When you go get your VA loan, what do you have to do with your token? Cash it in. So can you go get another loan? Another VA loan? Why not? Because you don't have your token anymore. When would you get your token back? When you pay it off. So if you pay that loan off, they give you your token back, and now you can go do what? You can go get another VA loan. But as long as your token's in play, you can't do what? You can't go get another VA loan. Does that make sense for everybody? So, let's talk about an assumption. If a veteran allows a non-veteran, so let's say Teresa wants to assume, you're not a vet, correct? Okay. Teresa wants to assume a veteran's loan, a VA loan. And why would she want to assume one? What would be the driving factor? Low interest rate. She's buying their house and the interest rate's really low, so she asked them, you know, can I assume your loan? Can I take over your loan? Was that allowed in a VA loan? Yes, absolutely. Here's what the veteran's going to have to decide. Do I want the ability to go get myself another VA loan or not? Because if that veteran allows Teresa to assume their mortgage, their token's still tied up with that mortgage. Does that make sense? Their token is still cashed in, so that veteran can't go get another VA loan until what happens? Until Teresa pays that loan off. Or refinances it, pays it off that way. Sells the property and pays it off. But somehow, as soon as that loan gets paid off, then the token comes back. The entitlement comes back. Does that make sense for everybody?
Yes, so the assumee would have to pay it off.
Yeah, whoever assumes the loan would have to pay it off. And as soon as it's paid off, the entitlement comes back. So it's a one-time, at-a-time thing. You can use it as many times as you want, but only once at a time. All good with that?
So it's better for them to find another vet.
If they can find another vet that wants to assume it, then their entitlement wouldn't stay tied up. That vet would use their entitlement in assuming the loan. So they just have to make a decision about it. Now, here's the thing. The veteran may not care about their entitlement. Because if they're selling the house to Teresa, and let's say they only owe $250 and she's paying them $300,000 for the house, now they got $50,000. If they got a down payment, they don't need a VA loan on the next purchase. What kind of loan are they going to do on the next purchase? They're going to do conventional. So they don't need the VA loan, so they'd probably be fine with her assuming that one. Does that make sense for everybody? Okay? No prepayment penalty, just like every other government-backed loan. And as we said, the entitlement gets restored when the loan's paid off, and it can be assumed by anybody. The last of the government-backed loans is the USDA loan. And here's literally all you need to know about it. It's available in rural areas. It's only available in rural areas. So could you do a USDA loan here inside the Beltline? No. No. Could you do one in Edgecombe County? Yes. Yes. You might need a cow cosign for you, but you can do one. The advantage of the USDA loan is that it's 100% loan to value. So basically it's 100% loan to value to entice people to buy in areas they ordinarily might not. They want you to move to a rural area. Okay, everybody all right with that? All right. Last few slides here, and then we will be done with chapter 15. Look at that, we're going to finish right on time. It's almost like we planned it that way. Okay? A lot of information. Don't you love it? It's awesome, isn't it? All right, purchase money mortgages. We've talked about these before, actually. We just called them something else. Seller financing. Remember when we talked about seller financing in the past? Seller financing is the same thing as a purchase money mortgage. So you just need to write down on this slide, seller finance or owner financing. They mean the same thing. What's happening in a seller finance deal? JJ is selling the house to Holly. And Holly's also doing what?
She's giving me a promissory note.
She's borrowing the money from JJ. JJ's going to have a promissory note. JJ's going to have a deed of trust. And she's going to make payments to JJ. And if she stops making those payments, what can he do? He can foreclose on the property just like any other lender would. That is seller financing. Does that make sense for everybody? Now, let me tell you what that's not. That's not an installment land contract or a contract for deed. Make sure you know the difference between an installment. What's the big difference there? In seller financing, who owns the property? The borrower. Holly does.
Do they get the promissory note?
There's a promissory note. There's a deed of trust. So if she defaults, JJ can foreclose just like any other lender. But in an installment land contract, who would own the property? The seller would. So JJ would while the payments were being made. That's the difference between the two, is where ownership is. Same transaction. It looks like the same transaction, but the big difference is in owner financing, ownership's already transferred, whereas in an installment land contract, we wait to transfer ownership until all the payments have been made. Does that make sense for everybody?
Yeah, because the installment land contract is rent to own.
It is rent to own, basically. Okay? Alright? So all you need to know is that purchase money mortgage means the same thing as seller financing. So if you see that on a test, don't freak out about it. Construction loans. Here's what you need to know about them. You put it in all caps across the top. Risky. Super, ultra risky from the lender's standpoint. Because they're lending against something that does not what? Exist yet. If they foreclose, what are they probably foreclosing on? A piece of vacant land. But they've loaned out the money to construct the house. Is that very risky?
Yes.
Yes. So how hard do you think these are to obtain?
Very hard.
Very hard to obtain. Construction loans are exceptionally hard to obtain because the lender has taken such a tremendous risk here. Usually the way it works is they pay the money out in what they call draws. Rather than one lump sum, they will pay it out in draws, and then they'll send an inspector out to look at the property and make sure progress is being made, and then they'll issue another draw, and they'll pay it out in dribs and drabs that way. But these are very tough loans to come by because they are so risky.
So
Only your best qualified borrowers are going to get these.
And they're gonna borrow, they're gonna pay it, the lender gonna pay it out in draws to who? To the seller who's
Usually to the contractor, to the builder.
Yeah, cause my just this weekend a friend of mine, she VA, and they getting a VA loan for a handicap built because he had a stroke, and they're gonna make all the doors wider, you know, make the handicap. But she was saying that the builder was giving them a hard time because he said he didn't want to take the VA loan.
Right. Because they're not going to pay him until after the work's done. They're going to
Yeah,
pay him
he
in
was
draws
saying
as the work is done.
He felt like they might shaft him or something. She's
That's
like,
the
what
way
are
it
you
works.
talking about?
That's the way it works with them. They won't pay anything out till they see some of the work done, and they'll pay that portion, and then they won't pay the rest until they see it finished.
Ah, so that's why he was cautious, a little more cautious.
Because he's having to take the risk.
Okay.
Yeah.
Okay. But if you do a good job, you'll get his money.
Well, I mean, you know, they don't see it that way because they're used to getting paid in advance. Most contractors are used to getting paid in advance, at least for materials. And so they're very uncomfortable spending their own money.
Oh, so they put their money
They
up
don't
front.
spend any of their own money.
Well, they're going to have to in this case if they want to work with that VA renovation loan.
Yeah, ours never spent a penny.
That's the way most of them work.
But if they get that VA loan, it would be in draws, like you said.
It will be in draws, and they'll have to, so basically be the contractor have to spend money, and then they'll get a draw, and then they'll finish the work, and then they'll get another draw, and, yeah.
Oh, yeah. I might not take long either.
There you go. I mean, it's very risky. Okay, are we good on construction loans? All right. As far as mortgage priority goes, we talked about this before. This is just the order in which mortgages get paid. And what do we say makes the difference? What order do we pay mortgages in? The order that they are recorded at the county courthouse. The one that's recorded first gets paid first. Okay. We also call that the first mortgage or the senior mortgage. We can call the subsequent ones a second mortgage or a junior mortgage. Usually the junior note or the second note is much riskier because it's second in what? In line to get paid. So there's more risk to be in. So usually if you've got a second mortgage, what do you think the interest rate is going to be compared to your first mortgage?
Higher.
Higher because the note or the risk is higher. Good, y'all starting to put the pieces together, I think. Higher risk, higher rate. Okay? All right, a couple of laws that you need to be aware of. The first is called the Truth in Lending Act. Now, this is not a real estate specific law. It deals with any time we are making any type of consumer loan. It could be a real estate loan. It could be a credit card loan. It could be a car loan. Any type of consumer loan falls under the Truth in Lending Act. So here's what the Truth in Lending Act says, basically. You should be really careful not to advertise loans. That's your big takeaway. Now, that's not what you're going to get on the test. I'm going to talk about the test in just a second. But for your purpose as a real estate broker, don't advertise loans. And I'm going to tell you why. Because if you're advertising loans, you've got to advertise all of this mess. See this paragraph right here? Those are called the 4 main disclosures, or the 4 chief disclosures. If you advertise a loan, and you've got to memorize these, so put an asterisk beside them, highlight them, you've got to know these 4 things and disclose them to anybody you're advertising that loan to. So give me an example of how you might be advertising property and in the process of that also be advertising a loan.
Low payments under $800.
Payments under $800 a month. Well, not only am I advertising the property, I'm also advertising what? The payment, which means I'm advertising a loan. Does that make sense? Because you can't have a payment unless you have a loan. And so if I do that, if I advertise that loan, then the rest of the story has to be told. I've also got to advertise or disclose the APR of the loan, which stands for annual percentage rate. The finance charges, so like all the origination fees, discount points, commitment fees, all of that has to be disclosed. The number and amount of all payments, in other words, how much the monthly payment would be and how many of those monthly payments I would be making. And finally, the total amount financed, so the loan amount has to be disclosed. That's if you advertise a loan. So does that sound like something you want to be putting on your listings? All that stuff? No. So what you need to do is learn to stay away from advertising a loan. Don't do it. And here, yes ma'am.
Sorry to cut off, but like I've seen on where it says like USDA loan approved.
Yep.
It doesn't have a lot of stuff.
Right. We're going to talk about it doesn't have to.
Okay.
Because that's not advertising a loan.
Okay.
That's our next step. And that's a great point though. Our next step is to decide when we are advertising a loan. So what Regulation Z of the Truth in Lending Act, you need to know that, Regulation Z. And here's how I remember Regulation Z. How many points are on a Z? How many? 4, right? How many things do you have to disclose? 4. 4 points on a Z. Boom, 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 boom. How many things do you have to disclose? 4, right? So Regulation Z says you have to disclose 4 things if you're advertising a loan. And it says you're advertising a loan if you use something called a trigger term. Trigger terms are things that trigger disclosure in your advertising. Are you with me so far? So now we need to talk about what a trigger term is. A trigger term is a number. A loan-related number. Now, not any number. Not every number is not a trigger term. 1,850 square feet, is that a number?
Yeah.
Yes, it's not a trigger term because it doesn't relate to what?
Financing.
To financing, it doesn't relate to a loan. Payments as low as $800 a month, is that a trigger term? Yes, because it's a number and it relates to financing or loan. Low monthly payments, is that a trigger term? No, there's no what? There's no number there. And so back to Patrice's question, she says she sees these signs that say USDA financing available. And it doesn't have all those things. Does it have to? No, because they haven't used any what? They haven't used any numbers, they haven't used any trigger terms. That's literally where the line in the sand is. Yes, ma'am, Michelle.
Where does it have to be advertised? Like if somebody puts lower payments or $800 a month on the sign in the yard.
Then right there where the sign is. So some kind of flyer right there in the flyer box. Same place.
Wow. I promise you I've seen that.
I'm sure you have. Just like you see people speed every day, right? I mean, it's true. People break the law. They do. But for you, you got to know it on a test, right? So, examples of trigger terms. 0 down. Is that a trigger term? Yes. 0 is a what? Number. No money down. Is that a trigger term? No, because there's no number used there. Payments as low as $800 a month. Trigger term?
Yes.
Yes. Low monthly payments? No. The key is don't use the what? The numbers. Those are trigger terms. Okay? The Equal Credit Opportunity Act. This is a non-discrimination law for lenders. It's not for us. It's for lenders. Because we don't make loans, lenders make loans. The Equal Credit Opportunity Act says you cannot discriminate when making a loan on the basis of these things. And you need to know these things. Race, color, religion, national origin, sex, marital status, age, or dependence on public assistance. So you cannot discriminate. In other words, you cannot deny somebody a loan because they are single. Because what is protected up here? Marital status. You cannot deny somebody a 30-year fixed rate mortgage because they're 87 years old.
Or 110.
Or 110. If they otherwise qualify, what do you have to do? Give them the loan. I had clients one time who closed on a house and he was 84 and she was 83. And they got a 30-year fixed rate note. And they sat there and they were signing that note, and when you sign the note, it's got the amortization table there, and it shows the date of every payment, all 360 of them over the course of 30 years. And they looked at the date of that last payment. I'll never forget what he said. He looked at her, he goes, I think we're going to win on that one. It's the cutest thing in the world. But it's a protected class as far as lending goes. Interestingly, when we get to fair housing, age is not a protected class in fair housing. So you're going to have to remember those differences. You need to learn these protected classes for the Equal Credit Opportunity Act. Okay? So it's race, color, religion, national origin, sex, marital status, age, or dependence on public assistance. In other words, if somebody gets a disability check, if they're on Social Security disability, okay, that has to be counted as income. You can't say, oh, we're not counting this income because it comes from this source. Or if they get a Social Security check or a government pension or whatever it happens to be. In the past, that's been an issue where some lenders did not want to count that as income for qualification purposes. They have to. They have to now.
Even welfare?
Any public assistance. Any public assistance. It counts as income. Okay, are we all good on that? Any public assistance counts as income. You cannot discriminate. You can certainly deny the mortgage if they don't qualify otherwise. We're not saying you have to give them a mortgage. We're simply saying you cannot discount that income. You cannot say, well, we don't count this type of income. That's what that means.
You don't worry about it, they don't have for the government to let them own no house.
She asked welfare. She said,
I didn't know that they paid people welfare, paid checks out to.
I don't know the ins and outs, quite honestly. I don't know if there's an actual cash payment or not, but if there was, then it could be counted as income. I don't think there is. I think it's mostly in the form of like vouchers and, like an EBT card and those kinds of things. I mean, even when they get like assistance with utilities, I think it goes directly to the utility companies, not as a cash payment. But if they're getting a cash payment, then it has to be counted.
They don't want you to have nothing, they ain't nobody giving you no house.
All right, the Fair Credit Reporting Act, last 2 slides here and then we're done. The Fair Credit Reporting Act basically gives you the right to check your credit report once per year for free. Once per year for free, you can check your credit report. And it does not affect your credit score at all to check your own credit score. You can check it as often as you like, but you can do it once per year for free. If you want to do it more often than that, you're probably going to have to pay.
And that's only the documented part, not the score?
I'm sorry?
Is it excluding the score?
Right, they don't have to provide you with the score, they just have to provide you with the actual report, because the score is a different thing. Yeah, just the report itself. Yes,
So if you check it often, does it count against you?
I'm sorry?
If you check it often, does it count?
No, you checking your credit does not impact it at all. If creditors check it, that's a different story, but you checking it personally does not. And last thing here, loan fraud, don't do it. So let me define loan fraud for you. It is any false statement made by anybody associated with the transaction to a lender. That is the definition of loan fraud. Any false statement. So if they falsify their income, if they falsify their employment, if they say they plan to live in the property even though they know they're going to rent it out, all of those would be false statements. Those are all loan fraud. And all loan fraud is a felony. There's no such thing as misdemeanor loan fraud. It's always a felony. And you'll just have to decide if it's worth the risk for you. It's punishable by 30 years in jail and $1 million fine.
You might get locked up for less time killing somebody than you are.
Then loan fraud, yes, absolutely. Absolutely. All right, so hold tight for just a second, and I'll go grab your quiz, and then you can escape, okay?
Yes.
All right, let me stop the camera and go grab your quiz, and then you're free.